Thank you, thank you. It's great to be here. Sun cleared up. It's like super nice out now. All right, so this talk is about cyber insurance, and I guess just quick show of hands. Has anyone ever been through a cyber insurance buying process? Okay, all right. Just curious. Okay, so who am I? So basically, just some background. I work primarily in the offensive pen testing side. I spent a little bit of time with a regulator in the U.S., and one of my jobs was to sort of figure out like the state of the cyber insurance market, right? And I was working for my boss. She's like, "We need to understand this. Go figure it out." And I didn't really know that much about insurance, so I had to sort of learn insurance. And I was like, "Wow, whole new world here. They speak different languages. There's like terms that I understand." I was Googling everything. So I felt like the goal of, like this talk is to try to clear some of that out for everyone. All right. So yeah, the goal is to try to just sort of take like all that insurance speak and like sort of distill it down so that people in InfoSec understand it. Because I feel like pretty strongly, especially in the States, that like cyber insurance is growing as a thing, and InfoSec is going to get dragged into these conversations like at some point. And just understanding what's going on with the policies, like where everyone is, like what this whole thing looks like, I think is going to be useful for InfoSec. All right, so I like history. Well, we're going to get there. All right, so what is insurance, right? So insurance is this like moral mechanism to spread risk around, and it's actually a good thing, right? Like, certain things like car insurance and homeowners insurance and health insurance, these things help us like live our lives so that we don't have like this like financial destruction that bankrupts us, right? So it is a good thing, right? And what is risk? We know what risk is. We're all in the risk management business. And what's exposure? Something that could experience that risk. Loss is a financial metric of that exposure and the risk. And a claim is sort of like asserting that you actually need someone else to pay for this, right? All right, so I like history, so I think the history of insurance is really, really interesting. So it all starts, or this is what it looks like it all starts with, is that Hammurabi actually came up with the first like idea of insurance. And back at this time, like the main sort of like companies were shipping companies, right? And they were shipping goods all over the planet, right? And so you had to like underwrite these things. You had to, there was venture capitalists that were paying for this boat to travel. And so sometimes if these boats were like sunk or like pirates took them over and the boat like sunk to the bottom of the sea, like it was like if you were the ship owner and you took out that loan, you would be like forever paying off something that was like a little bit out of your control, right? Like the ship sunk, like a pirate took it, like it had nothing to do with anything that you did, right? So the Code of Hammurabi actually said that if this does happen, you do not have to pay back that loan. So it's called bottomry, and if you look it up, it's like still a thing today in shipping insurance. So then we move into like, the guild time, right? And again, it's so funny to be talking about this at InfoSec conference. But all right, guilds, right? So like, we were trying to get everyone out of farming and into like, sort of like trade, right? It was like everyone's gonna have like a craft, people are blacksmiths, people are gonna be carpenters. In order to incentivize this like agricultural migration, you needed this like assurance, right? So guilds formed this like idea where, if you were like, if somebody like burned down or stole or killed you, the guild would actually pay your bills, like keep you or your family afloat, right? So this was like your insurance mechanism. And this was like group coverage, and then we still have group coverage today. Like when you have like health insurance, at least in the States, like it's like by your employer and there's group coverage, and that's kind of like where it all originated from. All right, next, Edward Lloyd's Coffee House. This is like fascinating. So, London was shipping center of the world, right? And, again, it was the same problem. Like, how do you know these ships are a good investment? Like, I'm looking to allocate capital. I want to, invest in this ship. How do I know? And I guess there's things you could ask. Like, all right, like, does this captain know what he's doing? What's the boat made out of? What's on the boat? Are there explosives? Is someone crazy? Is someone gonna, there's all these questions that make sense to ask, right? And so a lot of this was going down at this coffee house, right? And so Edward Lloyd would sort of observe this maritime speak going around and sort of realize that, he knew more about what's going to happen with these ships than anybody else did. So this was sort of like the beginning of underwriting, right? So he had this like institutional knowledge about like what's going to happen with these ships. People would come in there and be like, "Hey, Edward Lloyd, what's going to happen?" And he would sort of tell them. And this started Lloyd's of London, right? This is how Lloyd's of London got started. Pretty interesting story. All right, so moving on, probability was discovered, invented, in 1654, and this accelerated the process. At this point now, you could use probability to understand, it sort of formed actuarial science. You sort of had this expectation of what was gonna happen and what wasn't gonna happen. So it was sort of the math behind the whole thing. So another interesting Fun fact. All right, then the Great Fire of London happens in 1666, and this destroyed 14,000 buildings. It was a huge, devastating problem for London. And so the insurers that were previously writing these the maritime stuff were like, all right, we're gonna get into fire and life insurance. So there's this moral thing here, right? Which is like, we need to sort of like, protect against this risk, spread this risk better, right? All right, so in the US, and anyone who's like, Benjamin Franklin's like the coolest dude that ever come out of the US. So of course he started the first insurance company, and it was called the Philadelphia Contribution Ship. And what this was doing was saying, hey, if you're gonna get insurance with us, we need you to like not use mud and straw to build your houses. We need like bricks, like all sorts of different better technology that existed for building houses at the time. So this became like the origination of building codes and sort of like fostering like a better way to build things, right? All right, so insurance adapts, right? So we've just seen insurance adapt from shipping to houses to Benjamin Franklin, and it just continues to adapt. The Industrial Revolution, cars, these city fires, railways, then there's disability, life, accident, auto, business. It just keeps going, right? Insurance is like learning its lesson here as technology is evolving. Right? So this is a really interesting story. Hartford steam boiler. So steam power was like how the US Industrial Revolution sort of was powered, right? Steam power. There's a problem though. These boilers, these steam boilers, would explode like one every 4 days. They would like kill people in the streets. And like it was just poof, and people would die. And so that was just an expected like sort of thing that was going on with like industrialization, and like it was just like part of the deal, right? People were like, well, I don't know, should this be part of the deal? Like, is this a really great society if like you're walking down the street and a steam boiler explodes and you die, right? So there was like some big serious accidents. And one was the Sultana steamboat, and that was like all 4 boilers on the steamboat exploded at one time. Like 1,800 people died. It was terrible and tragic. So Hartford steam boiler decided that they were gonna like sort of change the game here a little bit. And if you like use different materials and you used like sort of like this inspection concept, they would actually write insurance against the boiler. And people were like, okay, that makes sense, right? I'm gonna like sort of like build my better boiler and you can come inspect it annually, that's cool. And what happened? I mean, boilers stopped exploding, right? Like it worked. So, it's like sort of like a reason why insurance could exist in a positive way. All right. So cyber insurance. So cyber insurance is like, this evolving thing. And we're not at a place where cyber insurance is at all like really mature, but it is this evolution, right? And so how did we get here? So in the 1990s, there was something called technology errors and omission. And errors and omission insurance is basically, if you screw up, you can get insured against you getting sued for screwing up, right? So it's sort of like that. We're gonna get into that a little bit later. But so it sort of grew out of that. You had technology screw ups and you wanted to insure against that. And then in 2000, Y2K happened. I guess nothing really happened then, but in 2010, it was like these decades of like big data breaches, especially in the US. And there was more regulation coming down the pipe. There was data breach notification laws in the US. Each state was coming up with their own version of this. It was getting complicated. But then in 2014, TJ Maxx, which is a retailer, finally settled with all of their class action lawsuits. And the bill was anywhere between $1 and $4 billion for them to figure out for their first party loss. And the class action lawsuits was about $177 million that they had to pay. So now it's like real money, right? So like real money started, like companies were now liable for like real money. So they're like, wait, can we insure against this risk, right? And so now in 2017, we have this like variety of different types of cyber insurance cover that you can buy, but it's important to understand like it's sort of coming out of this PII space. Like a lot of this is really coming out of the traditional privacy data breach space. All right. So this is complicated. Is cyber risk actually insurable, right? And I don't know, and I don't know if anyone really knows. But in the US, there's this concept of the made whole doctrine. You have something similar here, which basically, if you get like into a car accident, the insurance company's job is to like make you whole again. Like fix your car, fix your body, whatever you need fixed, and you walk out and you're like exactly how you were before the accident, right? So like, if you think about how that works in cyber, I don't know, like how do you make someone whole again after like a really large scale data breach? I mean, with credit cards, maybe you could figure this out, right? You reprint a new card, any fraud that's detected from that previous number being breached, you can kind of quantify that. But PII data, I don't know. I mean, is this like an insurable thing? Like, what if the data is used in 10 years or in 20 years? How would you ever know that, right? So it becomes this very complicated, is cyber risk actually insurable question? This is a question in the insurance space. I mean, it's just like important to know that this is out there. All right. So insurance industry today. It's hot in here, right? All right, so what's going on today, right? So we have these market participants, right? And this is a little bit oversimplified. There are more, right? But this is pretty much like the lay of the land. There's the brokers and the agents, there's these carriers, and then there's something called reinsurers, right? And we're gonna get into what all these people do. So the brokers. The brokers are like the middlemen for selling insurance, right? They're the sales infrastructure from the carriers to the buyers, right? It's like sales team, essentially. I mean, they do a little bit more than that, but that's kind of what they're doing. They're facilitating transactions with the people who want insurance and the carriers who write insurance. So these are the big three brokers, and they're the big three global brokers, Aon, Marsh, and Willis, right? But see, the brokers are sort of transforming a little bit, right? They sort of know that that transactional model of like, oh, hey, thanks for the insurance, see you later, is kind of like a little bit different in cyber. So a lot of the brokers are like moving more and more into like traditional InfoSec kind of roles. Like Aon bought Stroh's Friedberg, which is like a big InfoSec company, and they are now providing like value-added services that are like squarely in line with like incident response and cybersecurity and things like that. So the brokers sort of realize that the reinvention is like needed, and they're going to like sort of move more into the InfoSec territory as they try to provide services to their clients. I think that's interesting for anybody who's like, you know, in this InfoSec world, right? So what's the carrier? So a carrier is the company that holds the policy. They're the ones that they have to pay the bills. You pay them and they pay the bills, right? The brokers are no longer involved in this. Mostly true, right? So what's the goal of the carrier is to like sufficiently pool enough diverse risks so that they collect premiums from everyone and only pay out on a few, right? That's like the goal of the carrier, right? All right, so we have reinsurers. So reinsurers is like, I don't know, it's kind of like, oh, wow. All right, so what is reinsurance? So reinsurance is insurance for insurance companies. So insurance companies can then buy insurance to protect against their risk. So if you're an insurance company, you have this network of brokers, and all of a sudden you realize you've written too much risk in some sort of area. You could say, all right, that's too much, my audit committee is upset with me, I gotta do something about this. I have too much risk held up in one specific area. What do? You can sell that risk to a reinsurer, and the reinsurers will buy that, and then they will say, like, okay, we hold that risk now, so you're no longer liable for that. The reinsurers will pay it. It's kind of crazy, right? Like, yeah, sort of see how it gets built up. Okay, so types of insurance companies. This is important, right? Because when you're dealing with insurance companies, you kind of want to know like what kind of company you're dealing with, because there's very different models here, right? So the first one is standard lines or admitted carrier. And these are like traditional insurance companies that, you know, all of their policies in the US have to be approved by regulators. I think the same is true for Australia based on my conversations with people who know this market in Australia. But they have to be approved by regulators, right? So there's like a lot of regulatory oversight here if you're a standard carrier, right? You're an admitted carrier. There's a lot of regulatory oversight. And you have to participate. In the US, you have to pay into an insurance fund, right? Which is basically kind of like insurance against the fact that if your company goes bust and you can no longer pay your, you know, your liabilities, this insurance fund will pay them for you, right? Then there's this excess line. So the excess line or the surplus lines, this is like where more complicated risks get written. So like if you're like trying to, like people insure celebrity body parts, you could like insure like, you know, a musician's fingers or like a model's arms or something. And all of that gets written in these crazy specialty markets, right? But it seems, you know, this is a difficult number to quantify, but based on the research I've done, like a lot of cyber cover is coming out of the excess market. And the reason why this is like interesting is because the excess market is not very regulated at all. These policies don't necessarily have to go get regulatory approval. Every regulator will have a surplus lines office that sort of like deals with what's going on in this market, but it's sort of like, you know, kind of like do what you want there, right? You can participate in that market however you want, you can change your policies however you want. So it's interesting, right, from a cybersecurity standpoint. All right, so what's a captive? You know, why is this relevant? So a captive is an insurance company that, like, you know, you can't find insurance on a regular admitted or surplus line because it's just too expensive. So you could actually pool you could make your own insurance company with like another one of your competitors. So like here's an example, UPS and FedEx, delivery trucks, right? Let's just say they wanted to get insurance for like the trucks, and like, you know, a regular insurer was like, no, that's just gonna cost you this much. And you're like, well, it's too much for me, right? You could actually come together and make your own insurance company and like pay each other's bills if there's truck issues, right? So captive insurance company is a thing. People are doing captive cyber risk, and companies are pulling together their own resources and like paying each other's cyber risk bills. So that's a thing. Direct sellers, this is very simple, right? It's just a insurance company that doesn't have brokers. They sell direct, right, to customers. Domestic and alien, this just has to do with regulatory concerns, like where you're licensed to actually sell insurance, whether you're a domestic or you're an alien. And this is important just, as insurance is sold all around the world, so this just becomes important. Lloyd's of London, so this is very interesting. Lloyd's of London is not actually an insurance company. It's a corporate body that is governed by the Lloyd's Act of 1871 and subsequent acts of English Parliament. So it's a company that is like only a company because the English Parliament says it's a company, right? And so it's a syndicate network. So it's basically a bunch of different insurance companies that operate, again, to diversify risk. That's the goal of Lloyd's, right? All the syndicates are supposed to diversify risk. So it's a bunch of different insurance companies that like sort of are in the syndicate network, and like that's how it operates. Interesting, right? Mutual companies are companies that pay out their profits to their policyholders, and stock companies are insurance companies that pay out their profits to stockholders, right? All right, so commercial insurance. So this is where cyber exists, right? So in the commercial world, I will say that you can actually buy personal cyber insurance. There are companies that will sell you personal cyber insurance against like you getting ransomware or your family getting ransomware, things like that. But we're talking purely commercial here. So in the commercial world, there's something called the property and casualty lines, P&C for short, right? And so these are the types of policies that you can buy in the P&C world. This is not an exhaustive list. This is just like the most common, right? I'm not going to go through every single one of them, but there are overlaps where cyber becomes relevant, like kidnapping and ransom. You could buy K&R insurance for your executives, right? If they get held, like, or stolen or abducted, you could actually buy insurance against that problem. And like a helicopter will come in, like rescue them and like pay the ransom. Whatever happens there, they'll figure it out. But so ransomware is sort of similar, right? Your data is being held hostage. It's not that different, right? Errors and omissions in directors and officers. So this is also like kind of related. This is third-party liability insurance against you getting sued for like screwing up, right? So, again, like in cyber world, this could be a thing, right? Like something happened, you didn't patch, you had like a big error that you didn't foresee. Like this is something that that would cover, right, or potentially cover. But this is just the overlap. Product liability, you built a product that was then misused, right, in a cyber event, right? You could think like Mirai botnet, things like that. And then crime, right? Crime policies, cyber insurance, so sort of overlaps in that area as well. So it's just important to understand that it's still on the P&C line, right? And the P&C line, like traditionally, were like kind of like, it was like this, I don't want to say it was like sleepy, but there wasn't a lot of growth in the P&C market. It was a pretty flat market, right? And the cyber comes along and it's like, boom, right? There's like so many, there's so much excitement in the insurance space around property and casualty now. So almost 90% of the market is US demand. So the US is really driving this market right now. So it's not uncommon for like most financial services, healthcare, retailers in the US to all have cyber insurance cover, right? And why is this? I don't know. Regulation, there's a lot of strong regulation in the US now that's sort of driving this. There's the data breach is getting more and more expensive problem, and people want to insure against the cost of having to, deal with a data breach. And then there's GDPR, and GDPR is still like a little unknowable. I don't know if anyone has like gone through that. I mean, I'm assuming, we're all maybe working for global companies. We have data from all over the world, so this could hit, anyone, right? GDPR, but there's a little bit of like scary teeth in the GDPR regulation. Is that 4% of your revenue you could have to pay if you're like found to be GDPR not compliant. That's pretty scary, right? Like, I don't know. So this is driving the desire for cyber insurance, right? All right. So in insurance world, when you hear something about capacity is like the amount of carriers that are willing to write cover, right? So the amount of capacity that exists is like sort of like the amount of like the size of the market, right? So in cyber right now, the capacity is just exploded, right? There's like over 500 carriers now offering cyber insurance to businesses and individuals. And then that might be a little hard to read, but these are like sort of the main carriers. Like AIG is writing 17% of the market, Chubb is at 10%, and an aggregate of all the Lloyd's syndicates are at 20%. So these are like, three big players that are sort of holding around 50% of the market. Pretty interesting. All right, so just gonna like drill this in again because it's important. First party versus third party. When you get into any insurance discussion, this becomes a thing. Like what is first party insurance versus third party? So first party is things that happen to you, right? Like things that you have to fix on yourself or in your company. So how does that work in cyber? You have breach notification, you have credit monitoring services, you have PR services, you have to compensate the business for lost income, you have to pay ransom or an extortionist, that's first party. And third party is like things that you could get sued for, right? So these are things that you are liable for, and a third party could actually sue you, right? So this could be like, you're getting hit with like privacy lawsuits, or lawsuits relating to a data breach, or technology errors and omissions, right? You're getting sued for something, and third-party liability insurance will cover, or is intended to sort of cover lawsuits as a result. All right, so when you're looking at cyber insurance products, there's like this common language that shows up, right? And this is sort of like most basic parts of it, right? So what is coverage, right? Coverage is just like what they'll pay, what liability is covered by the actual policy. And a typical policy is a series of coverages, right? Limits. Limits are the maximum amount they're going to pay in the policy, right? So that's the max, right? The limit, right? Sublimits. Some policies have different coverage areas, and there'll be limits, sublimits around certain coverage areas. So it could be like a $2 million policy, but in this one specific section, they'll only pay $25,000, right? So that's a sublimit, right? What's an exclusion? And exclusions are kind of like, this is like where a lot of like the big stuff is happening, right? These are the things they won't pay for, right? And so you're thinking like, yeah, they're not going to pay for, I bet they're not going to pay for a lot, right? And like there are some articles out there, there's a lot of research out there about what they will and won't pay for. And we're going to get into that in a little bit. But, you can negotiate exclusions, right? So exclusions can be negotiated, and some of them make a lot of sense and some of them make no sense, right? So we're going to get into that, but these are the things that they won't pay for. A premium is the amount of money you have to pay to like get this policy. A deductible is the amount of money you have to pay to like initiate a claim, right? A claim is you saying, I need you to pay for this. Like this is this is a risk that I'm demanding coverage for. And again, first party versus third party, I just put it in there because it's really important to understand that as you go through these policies, what that means, first party versus third party. All right, so here's policy. So what I did is I took like basically 15 to 20 different policies, and I sort of read through them all. It's a long night. And tried to aggregate together like what I was seeing in terms of like what these things will cover, right? This is sort of like what they'll cover. So this is pretty much a common area here, incident response, right? So the policy here, and it's a $2 million limit, it's $5,000 deductible, and it costs $10,000 US dollars a year, right? This is sort of like basic numbers. This is from a real policy. Yeah, okay. So incident response. So what does that mean, right? Like it says incident response. This is first party stuff that happened to you. You have to pay for covering this incident, right? So you get like a 24/7 phone number. You can call them up, and this is like they'll like talk to you on the phone and say like, well, what happened? And they'll try to like sort of like identify either consultants that you can use, or they'll work with your IT team to try to figure out what's going on. They'll try to help you with your legal and regulatory costs, right? So you might have to get lawyers in the room and deal with all that stuff, right? Forensics and IT security costs, so they'll get like an IR firm in there. Either, it gets a little tough because sometimes they recommend one, and sometimes you have your own, or you have your own IT team, and you're just like, I got my own IR team that's going to do this. But so they'll cover some of this IT security and forensics costs, communication costs, dealing with the media, like, talking to the media about like your brand, like fixing your brand reputation, crisis communication, privacy breach management. This is like sending out that letter that says like, sorry, due to, something bad happened. And then post-breach remediation costs. So like a lot of times, I'm sure we've been through this, right? You get a phone call, anyone ever done IR before? And all of a sudden something really bad happens, and at the end they're like, okay, now we're gonna get super serious about security. Could you like do a risk assessment, right? Or like figure out like where our gaps are, right? This is common, right? Companies sometimes don't do anything until they have to. So a lot of cyber insurance will cover for that risk assessment or that gap analysis. All right, coverage area 2, cyber crime. Again, first party, stuff that happens to you, right? Stuff that you're liable for. So funds transfer fraud. All right, has anyone, it's a big thing in a lot of the clients I work with, fake invoices, ACH, or sort of SWIFT transactions that go out. This is like super common, right? So basically the way this works is like somebody phishes, or somebody, is business email compromised, or some sort of activity happens, and there's like a fake invoice scam that goes back and forth, and eventually the attackers convince a controller at an organization to pay it. And it goes out to some shady bank somewhere, and the money's never seen or heard from again. So it's fund transfer fraud. And so they'll cover some of this, right? Like they'll unauthorized fund transfer. But if you look there's like a sublimit, right? $250,000. So the $2 million policy is now shrinking, and if you get, fund transfer fraud, your CEO or CFO gets phished, pays a fake invoice to somebody, and it was $1 million, they're only going to cover $250,000, right? So there's like some details here that are kind of really important. Theft of funds in escrow and personal funds, sort of similar. Extortion, right? This is it. This is the ransomware, right? So you get ransomware, and it's like you get the big message, and you're like, all right, I got to come up with this Bitcoin. What's this Bitcoin, right? So they'll cover the cost of you trying to get that Bitcoin and trying to pay, or the Monero, whatever it is, and trying to pay your ransomware. And if you notice here, the sublimit there is $2 million. Why is that? Because ransomware is like a highly marketable thing it's easy to sell insurance on the sort of like, oh, we can protect you against ransomware. It makes sense, right? From a business standpoint, I guess. All right, corporate identity theft, fraudulent use of electronic identity, telephone hacking, phishing, the cost of fraudulent emails, reputational repair. So that's all sort of cybercrime related stuff. All right, coverage area 3, system damage and business interruption. Again, first party loss. This is like the system goes down and you have to like deal with the fact that it's going to cost you money to get it back up. And this is sort of where that cover comes in. System goes down due to a cyber event, right? So system damage and rectification costs, everyone has to work overtime. It's just nonstop, all hands on deck until we get the systems up. Business interruption costs, like let's just say you have find new suppliers, you have to find a different way of doing your business because this system's not working and blah, 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 they'll cover that. Reputational harm around you not being a business right now. And then loss adjustment costs. So this is like tricky, right? This is how much money you lost as a result of you not being in business. There's a sublimit there, $25,000, right? That's very low, right? So, this is like sort of how this is going down. And, it's just good to know that these things exist. So if you're ever in a room and you have to like negotiate this stuff, you sort of can ask these questions and say like, well, what's the sublimit on this? Like, I want to know. And like, you have lawyers in the room and they're going to want to know that too. All right, coverage area 4, this is a very traditional part of cyber cover, network security and privacy liability. So now we're at third party. Again, this is stuff that you can get sued for, right? So network security liability, you transmit malware to a third party, you're part of a DDoS attack, failure to prevent unauthorized access to information. So this is like stuff you can get sued for. Like you can get sued for this stuff. So they will cover the cost of what that means. Privacy liability, again, liability for PII, PHI, PCI data, failure to warn, failure to maintain confidentiality, breach of privacy policy, and other confidential breaches. So again, class actions around privacy data, that's where that falls. Management liability. So this is like cyber D&O. And in insurance speak, D&O stands for directors and officers. So these are like, the people in charge of the company, right? If they have if they screw up, right? You can sue them, right? And like that is like what this will cover is like the cost of you getting sued because your directors and officers acted in a way that somebody feels is negligent or, inappropriate. Regulatory fines. So this is a little tricky. Like they will pay some regulatory fines. A lot of it is around PCI, and there's a reason why this makes sense. So if you're a company and you know that you can get fined by a regulator, and then you just say, I can insure that risk, so I don't care. Like that's not the point of insurance, right? So it sort of makes sense why they wouldn't want to pay that because it's again, you're dealing with morality here, right? Like you can't just offload risk of getting fined by the government to an insurance company and then just act like you don't care about it. So, yeah. All right, media liability. This is again pretty common in a lot of these policies. Defamation, if you're getting sued for defamation, slander, disparagement, if you're getting sued for infringing intellectual property rights. This is, again, covered in third-party liability. This is a big one, technology E&O. So if you're working for a service provider and you have SLAs in place, you're a managed security service provider, you're doing something like that, and you have clients and you have SLAs in place, and something happens or you screw up or something goes wrong and you get sued for either breach of contract or having some sort of problem with the management of this account, you can buy technology E&O against that risk, right? And so that's pretty cool. But it gets a little crazy when you start thinking about large cloud providers. How could they ever, who would ever write technology E&O against Amazon or Azure? I mean, I don't know. How would you even quantify that risk? It just gets crazy. All right, court attendance costs, coverage area 7. So this is they'll pay areas where, however much it costs you to show up in court, right? All right, so those are the big areas of coverage in the cyber insurance market as it is today, right? These are policies I read that were very recent. This is what it looked like as of 2018. This is going to change pretty rapidly, but this is the state of affairs. Okay, so common exclusions. So what are common exclusions? So property damage, right? It's pretty much excluded in all policies, right? Property damage. So what would first party loss be in property damage? Stuxnet, right? things blew up, things didn't work anymore, there was like a first-party loss that the Iranian government suffered as a result of a cyber attack, right? It's just an example. I'm not saying this should have ever been like coverable risk, but it's just an example of first-party loss due to a cyber event. Third-party loss. This is actually pretty interesting. I guess somebody like got upset. It was an internal employee, got upset and like issued like malicious radio commands, but like knew what he was doing, to a water treatment plant and like just dumped sewage all over the place. This was back in 2000, so it was kind of a long time ago. But like it like polluted rivers and like killed all its marine life, and like anyone who lived around it was probably just like severely just, it wasn't good, right? So that would be third-party loss due to a cyber attack that affected other people, right? But this is all excluded. Bodily injury. So bodily injury from a cyber attack is also a common exclusion. So in the first-party world, like things that happen to you, this would probably be covered by workers' comp, right? Because if like, let's just say, I don't know, your data center, like somebody hits like your, I don't know, badge system and locks you in the data center for 3 days and you're freezing and like, I don't know, your fingers get a little, I don't know, whatever, something like that. Maybe workers' comp will like cover that, right? Third-party loss. This is a real one. In Lodz in Poland, a teenager rewired a remote control, caused the train to hop the rail and hit another train, and people got like hurt. I mean, not severely hurt, but you know, hurt enough. And so that was like bodily injury caused by a cyber attack for third-party loss, right? Intellectual property. So, you know, from my research, this is a common exclusion. How do you quantify the cost of the secret recipe of Coca-Cola? And I Google imaged it, and that's what came up. So I don't know, maybe it's not so secret, but yeah. But I was just talking to somebody prior, and she was telling me that there are some carriers that will try to cover first-party loss due to intellectual property. So maybe this is evolving quicker than I thought, right? But generally, the policies I looked at is intellectual property. If somebody maliciously steals your intellectual property as part of a cyber attack, it's not coverable risk, or it's an excluded risk. War and terrorism. This is a big one, right? So in the US, like there's a lot of, you know, people are like, oh, is this person, right? This is like a big thing now, right? So when you had like, you know, the Sony hack against, the Sony hack with the movie that leaked out on the internet, right? Obama was like, it's not an act of war, it's cyber vandalism. So I don't really know what cyber vandalism means, right? But I think it was an initial act of war statement, and then it was like a little confusing. Is it an act of war, is it not? And then even recently, Donald Trump blamed Russia for not Petya. So at this point, the insurance companies are like, okay, well, this is an act of war and or terrorism. We don't have to pay this, right? So this is a, you know, a thing, right? Like if something happens like this and they're just like, all right, the government says it's act of war, and like then you get into questions about like attribution and are they really right? Is it really North Korea? Is it really this? I mean, because you can go down a rabbit hole on this stuff, right? Like, so I'm not gonna get into attribution. All right, other common exclusions, right? If you're unlawfully collecting data, right? So if you're collecting data that you have no right to, that is illegal to collect, they will exclude that. Crime or fraud. If this is provable to be actual crime or fraud, they will exclude that. Failure to enact security. This is actually a good one, right? So this is like, and there's a case in the US right now about this. So this is basically saying like, when you're trying to get a cyber insurance policy, like you have to fill out a questionnaire. We're gonna get into underwriting in a second. But like, failure to enact security is basically like doing like the most basic things that you need to do to like have a security program, or at least make it passable that you actually have an InfoSec program, right? So if you're failing to do that, they can use that as an exclusion. And then you're like, oh wow, that's a huge gray area. And it is, right? And this is why the courts in the US are trying to settle this. But it's kind of a good thing, right? Because you really want like failure to enact security to like be something that companies don't do. You don't want people to buy insurance because they're just gonna like offload the risk to somebody else. You want this to work so that people buy insurance and there's like sort of this hand-in-hand thing so that cybersecurity gets better, InfoSec gets better, and your cyber insurance is there when you need it, right? It's sort of like why the health insurers and the life insurers are trying to promote like Apple Watches and Fitbits, right? Like everyone does better with this healthier society type of thing. So, I don't know, all right. Core internet failure, this is a good one, right? So if the internet goes down, right, and this is like broadly defined, like failure of the IP addressing system, I'm not really sure what that means. I'm guessing it's like BGP problems, something like that. But like core root servers go down, you know, core internet machinery goes down, and that's excluded, right? Contractual liability is another good one. So if you have contractual liabilities with your third parties, and there's another case we're going to get to about this in a second, they will exclude that. So basically they're saying is like, we cannot write the cost of all of your contractual liabilities. You have to be liable for that. So if a cyber event causes one of your third parties to get upset with you, and like you have to pay something as part of that contract, you have to pay that, right? And exclusions, right? So if you're in a room like this, you have to deal with like cyber insurers, you can negotiate exclusions, right? The devil's in the details, and these are the details that you should be looking out for. All right, underwriting. So people are always like, well, how do they know? How do they underwrite, right? This is, I don't know, right? This is like, it's hard, right? Underwriting is hard. If somebody said to you, figure out when the next cyber attack is going to happen, like, I don't know, I'd have a tough time with this, right? It's hard, right? So I spoke to a lot of underwriters to try to figure out like how they do this. And everyone was like, well, this is not a science, this is an art, right? So hence the art of underwriting. So these are the most like common things that they're doing, right? So they do this like organizational thing where they send out a questionnaire, and some of these questionnaires are a lot longer than others, some of them are more basic, but they try to get like comprehensive information about the company, the vertical, revenue size, what regulatory stuff exists around the company, like are they holding sort of really valuable data that they could be fined for, things like that. Data collection, what are they collecting? Do they even have PHI data, PII data, PCI data, like the type of data they're collecting? Tech inventory, like where is all their infrastructure? Is it here? Is it in AWS? Is it in Azure? Like where is it all? How do they access this? Like what's going on with that? Security controls, this is like standard InfoSec stuff, like using endpoint AV, IPS, IDS, SIMs, log correlations, things like that. And then, depending on the size of the company, they'll bring you in for meetings, and they'll bring in the CISO and the CTO, and they'll be like, we want to know more. And here's our, they're going to have like a security person in there. Like a lot of them are hiring security people, so they'll have security people in there, and they'll try to be like, okay, well, let's walk us through your InfoSec program. Like I want to know how it's going, right? So they'll bring you in for meetings. They evaluate financial statements, and there's like kind of this thing, and I thought about it a lot, and I was like, I don't know. But then I thought about it, and I was like, maybe this makes sense. A lot of insurers, a lot of carriers believe that if you have like really strong financial statements, that's sort of indicative of the way you operate as a business, and you're most likely paying more attention to InfoSec because you're good at your financial statements and you're good at your accounting and everything like that. You have budget for InfoSec, like we want to know all that. And I was like, well, I guess that's true. And then I thought about all the companies that I've worked for, and some of the ones that were a real mess, like yeah, their financials were a mess too, and some of the ones that were really good, they had really good financials. So I was like, all right, maybe there's something to that. But anyway, they look at a lot of financial statements. They use third-party resources, and there are companies out there like BitSight and Science. I'm not plugging them at all. I'm just saying that they exist. That basically go out to the internet and they try to like assess risk, security scorecard style, like from afar, and say like we think this company has a risk metric of some arbitrary number that isn't arbitrary to them. Okay. So this is a component of underwriting. The carriers will use this. And then they use their models, right? And this is sort of the actuarial science. They input a lot of this data. And all the insurance carriers care about is any of this data going to trigger a claim? If it's going to trigger a claim, we need to know about that because, again, they don't want to pay the claim, right? They don't want you to trigger a claim. They want this to like sort of work well for them. So that's sort of like, the core cross-section of how I experience underwriting via my sources. All right, so underwriting challenges, right? So there's a lot of challenges here, right? So the first one is lack of data. And there's like super massive reporting bias against people who don't want to report data breach disclosures or any other cyber attacks because of fear of all sorts of things, right? And so insurers are dealing with like reporting bias. Like that's that simple. So what are insurers doing? A lot of them are trying to like really sort of like say like, hey, please call us if you think anything happened. Like we want to be your friends. Like please call us, right? So they're trying to like incentivize a better relationship here, right? Accumulation. So this is a big thing in insurance space. In any underwriting activity, it's a big thing. Have you accumulated too much risk in any area? So you could think of like in the US, South Florida gets hit with hurricanes all the time, right? And insurers are like very careful about how much risk they underwrite in certain zip codes in South Florida because it's just too much accumulative risk that happens, right? You could sell off some of that risk, right? That's what reinsurers are for. Or you could just not write it, right? Or you could just write it really high premiums. So in cyber world, what is the accumulation problem? It's kind of similar, except there's no zip codes now. So now it's like, all right, is everyone using the same cloud service provider? Is everyone on OpenSSL XYZ that like caused, Heartbleed? Is everyone on, some old version of jQuery that, whatever? So it's sort of like accumulation around versioning or accumulation around like what cloud providers you're using, right? There's some accumulative risk there. And this was just a couple weeks ago. Lloyd's came out and said, cloud computing failure in the US can cause like $19 billion in losses. And I'll put up these slides later. You can click on that link and like read all about it. So that's pretty crazy because I think the insurance market right now, the cyber insurance market, it's about $1 billion, $2 billion. Like that's how much money they're collecting in premiums. And it's expected to grow to like 20 billion. They're making these numbers up, but like this is what they think, like $20 billion by 2020. So this market is growing, right? So it's like if you're gonna have accumulation risk, you gotta like deal with that, right? All right. Evolution of risk. So the auto world, like that was like all locked up, and then like self-driving cars happened, right? And now it's like we got to figure this out again, right? So risk is constantly changing, right? You know, the cyber risk products today are like really geared towards PII, and PII is important, and confidentiality is important. But like, you know, if you listen to like sort of like some of these people in the cyber world, they think that the next evolution of risk is integrity attacks, right? And attacking algorithms, attacking AI, attacking things like that, where like maybe it's not so clear. Maybe that data breach insurance is not going to actually do much for me. Like my business doesn't work like that, and like I have different risks involved here. So like insurers have to like sort of evolve with the different types of, you know, attacks that could happen, cyber attacks that could happen. Narrow view. So that's kind of what I was just saying before. There's a little bit of a narrow view around what constitutes cyber risk. It's mostly focused around the PHI confidentiality space. So narrow view. Standardization. So, you know, if you go through these policies, and there's a link where if you want to like read policies, you could like look them up. Some of them are in public domain. But these things read like they're completely different things. You read one to the next, and it's like nothing even overlaps, right? You sort of have to like figure this out on your own. So the fact that there's not a lot of standardization, like in auto insurance, like you don't have this problem. Like you're not like, all right, like, well, what do you mean? Like I don't understand what that means versus this versus that. It's very standard stuff here. So in the cyber world, there's not a lot of standardization on these policies. So this is a problem because consumers then have no idea what's going on, right? And like this is what happens. This is why I feel like insurance just eventually becomes like lawyers. I think it's because of this. So a lot of regulators are coming up with ways to like sort of try to make these policies more clear to read, and some of them are even proposing like this Fleisch-Kincaid score thing, where like it has to be readable at like a 5th or 6th grade reading level, otherwise it's like it's not okay. I don't know. All right, confusion. Again, that's probably based on the lack of standardization, but buyers are really confused as to what's going on, right? Like their policies are all over the place. People don't really understand like what this risk actually means, why I need it, what am I even protecting against? This doesn't make any sense. So, you know, the insurance industry sort of needs to figure out like how they're going to like speak about this more eloquently. All right, there's also super unclear legal and regulatory rules. None of this makes sense yet. There's not a lot of case law around this, especially in the US. There's a few cases we're gonna get to, but you know, it's still like the regulatory world's kind of a mess. Like, you know, in the US we have 50 states, and each one of them has like a way to like sort of invoke their own regulatory thing. And then there's a federal government, so it's complicated there. It sounds like it's complicated everywhere. I don't know anywhere, any country that has like super clear regulatory operating environments, but all right. So when insurance gets it wrong, right? And this is like, I feel like everyone's like, all right, well, I see a lot of problems ahead, like with what's going on here. And there are some really good case studies when insurance gets it wrong. So Lloyd's of London, right? They were writing workers' comp claims, or they were writing workers' comp insurance in the 70s and 80s, and they misunderstood like how deep the asbestos problem was in the US. And asbestos was like this building material that everyone thought was great, and it wound up causing like horrible lung diseases, and people were dying, and it was like, it almost bankrupted Lloyd's of London. They have this big tower in downtown London. They had to like sell it. It was like crazy. It was like a big problem. It's a big old insurance company, right? So insurance can get this really wrong. And GE is having this problem right now. They wrote all this long-term care insurance, and long-term care in the States is basically like, you wanna like hedge against like, I might be in a nursing home for 20 years and I can't afford that. So you could buy long-term care insurance to like hedge against that. And people in the US you probably all know about our disastrous healthcare system, but you know, it's expensive, right? So GE misunderstood how expensive this was going to be, and they're on the hook for billions of dollars right now, and it's affecting their bottom line. If you Google GE long-term health, you'll see what I mean. All right, so this is the craziest part. So cat bonds. Has anyone heard of a catastrophe bond? Catastrophe bond. All right, so this is cool, right? So this is securitized insurance, right? So back in 1992, Hurricane Andrew hit the US and caused like, you know, an enormous amount of damage. So insurers were like, wait a second, we can't deal with this risk by ourselves. And the reinsurers can't deal with this risk by ourselves. So what we're gonna do is we're gonna sell bonds so people can buy the bonds, and we pay them the coupon rate plus more, so it's fixed income. And as long as nothing happens, you have income coming in. You're buying cat bonds and you're making money as long as nothing happens. But if something does happen, we got to take all that principal, right? And that's it. You know, you lose all your money, right? That's sort of the risk, right? So this was a thing, and it still is a thing. People sell cat bonds right now for a lot of hurricane risk. But people want to come up with like cyber cat bonds, right? And this is not a thing right now, but if you Google this, people are proposing coming up with cyber catastrophe bonds. And there's like a few different ways. Like if someone's like, would you buy an AWS cat bond? Or an Azure cat bond? I mean, I don't know, maybe, right? Like AWS, the guy up there, Keynote, I mean, I don't know, he seemed like he knows what he's doing. Like maybe I'd buy a Azure, cat bond. So, but that's like one way that they're proposing it. Another way that it's being proposed is like, it's geographical. So like the US identifies all its like critical infrastructure and then cat bonds it and sells it to China, Russia, Australia, wherever, all over Europe. And then that all happens. So each country is holding each other's cyber cat bonds, which maybe disincentivizes all the countries from attacking each other. I don't know. I mean, just wanted you to know it's out there. All right. Partnerships. This is also a little awkward, right? So a lot of insurers are developing partnerships with like IT companies, right? So like Apple, Cisco, technology companies, Aon, the broker, and Allianz, the insurer, the carrier, came together and they're like, hey, if you buy Apple and Cisco products, we're gonna give you like a super better rate on insurance, right? So imagine IT is like, wait a second, we have to, all those like, Juniper, Palos, whatever we got on the perimeter, we gotta change that out. Because we bought this insurance and it says we have to use Cisco. I don't know. I mean, that's a little bit awkward, right? Like Symantec and Travelers have a thing together. Someone's like, yeah, you got to use SEP. I might be like, well, I don't know. All right. So legal tests. All right. So where is this getting tested, right? And these are two good cases. So P.F. Chang's, which is a restaurant in the U.S., had a lawsuit with Chubb over credit card data. And basically what happened is 60,000 credit cards were breached. It cost P.F. Chang's all this money to fix it, and Chubb paid most of their bills. But there was one bill that was coming from Bank of America Merchant Service. That was their acquiring bank. When they swiped the credit cards, Bank of America, that was the acquiring bank. So Chubb argued that, hey, listen, we're not paying that because you had contractual liability with a third party, and we don't cover contractual liabilities with a third party. And the courts ruled in favor of Chubb, and they didn't pay it out. So that's like one case law that's kind of pretty interesting. The second one is still going on, and this is Columbia Casualty versus Cottage Health. And this is a healthcare company. It's not an insurer. It's like one of these like network things. And we have a lot of those. So someone stole like 32,000 medical records, and Cottage, the net healthcare network, went to their carrier, Columbia Casualty, which is a Lloyd's syndicate, CNA, and said, you have to pay this. And Lloyd's was like, well, all right, let's see, and realized that they had like default passwords and that they lied on their risk control assessment, right? And they basically were like, that's called a failure to enact security, right? And like that's what we were talking about in the exclusions before. And there's something good about this, right? You kind of want like Lloyd's to win because again, you shouldn't be allowed to like operate with like default passwords and like lying on risk assessments and then just expect somebody else to pay your bills. What do you think is going to happen when default passwords are in play? I mean, it's pretty obvious. So that's kind of an interesting one. But if you want to look at some of these policies in the US, there's something called the SURF Filing Access System. And you could like Google this, and you could like Google all these cyber insurance policies, download them and read them. And it's actually, these are mostly admitted carrier policies. The surplus line is a little bit more difficult to find, but that's sort of like, where you can go to like orient yourself on like what's going on here. And yeah, that's that. Yeah.
So I did see a couple of heads explode in the audience there as you explained that, so thank you. Anyone got any questions?
Have you seen any good outcomes with cyber insurance?
Yeah, there are. Like, especially against like PII stuff and like liability around PII stuff, it's a more mature space, right? That's definitely the most mature space of all the cyber insurance policies that are out there. So that could be a good outcome if that's like a lot of your business risk. And a lot of the business interruption stuff too, like if you want to hedge against like Azure never goes down, but like if it did, right, like what that would cost your business, you can hedge against that using some of these cyber insurance policies. So it's still a very immature market though. Like, and I think like the other part about it is if you're in InfoSec, like there are like jobs in insurance companies right now. Like they are hiring cyber people. They are like acquiring cybersecurity firms. Like they're like in this space. Like I feel like it's just a matter of time before they like roll up to conferences like this. Yeah, so.
Many open source underwriting techniques because those guys learn a lot from the security community. Vice versa, they probably use like Monte Carlo simulation and all that kind of stuff to set risk. So are there any that are open source?
There are not any open source underwriting techniques. But that would be cool if somebody in InfoSec decided that they could, like I've thought about this a little bit. Like imagine you came up with a novel way to underwrite this stuff or assess this risk. Probably an insurance company would take you out or buy up whatever technology that is. Because this is how they make their money, right? Yeah. So there's a lot of, yeah.
So like related questions there.
Say again? You know, I don't know. I think it's probably considered like intellectual property of the insurance company. I mean, these models change quickly. Like they're on it. Like they know what they're. I mean, they mostly have like more mature actuarial processes. I think cyber is a little bit different because again, we have different problems here in cyber. The accumulation problem is very difficult to geo-bound cyber. You can't do it. It doesn't geo-bound anymore. So there are issues, right, that they have to kind of solve. But I don't know. I think that there's pretty much intellectual property because patent you'd have to make it public. It's in the U.S. The U.S. patent system, it has to then be public, and then people would steal it, and they would be like, no. So. Yeah, so that's a good question. The question is, what kind of discount are you seeing for premiums if you're proactive in security? And I feel like that's like exactly where the market needs to head, right? Like you can definitively prove that like you're better than like the baseline, right? Or you're at the baseline, right? There's always going to be like edge case scenarios, right? And you can't control for everything. Like meteors happen, right? This is real, right? So it's like you want to be able to just sort of like manage like the most basic risks. And I feel like if the insurance companies can come up with a way to have a financial incentive to do that, basically saying like, okay, you get cheaper policy if you actually don't, you know, or no default passwords, you have an InfoSec program, you know, you got like, you know, correlated logging, you have people watching, you know what's going on, right? That could then help raise the bar here. So I think like that's where I would love to see the industry head. I think it's going to be both, right? I think it's going to be like quantifying both of those, right? Like if you have good governance, you're probably going to have good technical controls. I mean, if you sort of think about like the correlation here around like a company that does have good governance, like they're probably going to invest in InfoSec. They probably believe that this is part of their, you know, like the GRC activity should identify risk at least, and then you would then put money towards it. So I do think they're, you know, I don't know. I think so.
Another round of applause for Nicole.
Thank you, guys.